Hey everyone, welcome to Edge Strategy Lab, straightforward insights on stocks and ETFs for everyday investors. Today, we're looking at two magnificent seven giants, Apple, ticker Apple, and Meta platforms, ticker META. As of mid-January 2026, both are feeling pressure in a broader tech pullback, but their stories are quite different. Apple is dealing with valuation concerns and slower growth, while Meta is pushing hard on AI despite heavy spending worries. Let's break down the latest data and what it means. Starting with Apple, APL. The stock is trading around $258 to $261 today, down about 0.5% to 1% in recent sessions. Shares have dropped roughly 8% so far in 2026 after hitting highs near $288 late last year. In 2025, Apple gained only about 8 to 11%, lagging the S&P 500's stronger performance. The main issue? A valuation reset, trading at over 31 times 2026 earnings, a premium to peers with more modest growth expected ahead. Analyst consensus shows a median 12-month price target around $284 to $300, implying 9 to 15% upside from here. High-end targets reach $350 from firms like Wedbush, betting on an installed base upgrade cycle for iPhones. Lower targets sit at $215, citing regulatory pressures, China exposure, and diversification challenges. India now handles about 20% of iPhone production, up significantly. Key catalysts for 2026 include potential foldable iPhone launches, staggered product releases to smooth revenue volatility, though some sales might shift into 2027, and Apple Intelligence features ramping up. But chip shortages and AI competition could limit iPhone momentum. Earnings at the end of January will be critical. Watch holiday quarter numbers and any AI or product updates. Now shifting to Meta platforms, Meta. The stock is around $615 to $631 today, also down 1 to 2% recently. It's pulled back 16 to 22% from its August 2025 peak of about $796, largely on AI capex fears. After a solid 2025 with around 13% gains, Q3 earnings triggered the sell-off due to $100 billion plus planned spending on AI infrastructure in 2026. But fundamentals remain strong. Revenue jumped 26% last quarter, driven by resilient ads. Consensus analyst targets sit at a median $825 to $837, suggesting 30% plus upside, with some as high as $1,117. Firms like Jefferies and others see strong buy ratings, pointing to AI surprises like new models, Threads growth, and WhatsApp monetization. Meta's big bet is on AI agents and open-source pushes. Zuckerberg says Meta AI could become the most used assistant soon. Risks include high spending pressuring cash flow, ongoing metaverse cuts, and regulatory noise. At around 22 times 2026 earnings, though, many view it as attractive risk-reward. Quick comparison, Apple feels more like a stable, balance sheet powerhouse with services growth, but at a premium valuation and slower innovation pace. Meta is the higher upside, higher volatility play, massive AI potential if execution delivers, but more exposed to spending scrutiny. Both remain core in many ETF portfolios, like VOO or QQQ holdings. If you're long-term focused, these January dips could be entry points. Short-term, keep an eye on earnings, AI news, and macro moves. That's the current picture on Apple and Meta. What are your thoughts? Are you leaning toward one over the other in 2026? Drop a comment below. I read them all. If this helped, hit subscribe for more updates like this, and check the description for sources. Thanks for watching. Talk soon.